This is Brien Lundin with Gold Newsletter, and today we're talking with Tom Denham of Elliott Wave International. Tom's been providing market analysis for Elliott Wave International for more than 11 years, covering multiple markets, including metals, European stocks, and currencies during that time. Today, Tom's the editor of EWI's Metals Pro service, providing intraday and daily analysis of gold, silver, copper, and other major metals. Tom began trading financial markets just after the 1987 stock market crash. He was a chaplain and psychotherapist for 15 years and approaches the analysis of markets with a deep understanding of human psychology. Tom, that's a very interesting background for the financial markets analysis, I have to say. Do you find that really gives you an advantage?
Well, Brian, my background is what made me interested in the Elliott Wave principle, because the wave principle is based on the idea of social mood as the driving force behind markets. I was practicing as a marriage therapist in 1987, and I very well remember a particular couple that came in. They were wealthier than many of my clients, and they were distraught right after the 1987 crash. The husband was in a panic and was selling all of the stocks. His wife was saying, "Don't sell now, don't sell, don't sell." I was not active in the market at that point, but I got interested because of my clients, because they were so upset. So I began to look at things. Of course, if we go back, the 1987 crash was a very dramatic, sharp move down. Then it made a bottom. It just kind of fumbled around for a long time and then gradually edged up from there. So the wife saying to her husband, "Don't sell now," well, she was right. And here's another interesting thing from around the same time. I came across some old newspapers, also from 1987, but from just before the crash. I started looking in the paper to see if anything in the financial sections would warn you that we're about to experience a great crash in the market.
And let me guess, there was nothing.
Nothing, not the slightest clue. And then there was this tremendous crash. It made me curious about markets. And that's how, when I heard about the wave principle, that I was very interested. Because the idea that markets were driven by social mood, or to put it differently, people's feelings on a large scale, that's what caused the crash, I said, that makes sense. That fits the behavior I've seen in my therapy practice. So I want to learn more about how this works and how to understand it.
That's fascinating. You know, I'm a longtime friend and admirer of Bob Proctor, and he's, I think, undoubtedly the leading proponent and advocate of that socioeconomic theory of finance and out there. And what he and all of you at EWI do is really associate these trends in society and these rhythms of human nature with their ultimate impact on the markets through Elliott Wave. And, you know, looking at that and getting to the gold market, which is our topic for today, your Elliott Wave analysis for gold predicts the metal rising to about $1,460 within the next couple of years, but then dropping to as low as $681 by 2022 to 2024. Now, that's a pretty stunning prediction that I don't think many gold analysts are sharing right now. Can you explain the analysis behind that forecast?
Yes. Between 1999 and 2011, gold formed 5 waves up, which in Elliott Wave terms was a complete bull market. That told us that we should get a 3-wave pullback, and that's where gold has been since 2011. The level that we expect a market to go after it has completed 5 waves up is often to the previous 4th wave low. It doesn't happen perfectly, but it happens pretty regularly. Price comes back into the range of that previous 4th wave and often goes all the way to the low of that 4th wave. The low of the 4th wave of the 5-wave rally in gold that topped in 2011 is at 681. My prediction that prices ultimately are going to get back down to that previous 4th wave low has nothing to do with fundamentals. It has nothing to do with an outlook for currencies or other markets. It's simply that I see a 5-wave rally in gold and I'm now looking for it to come back to the previous fourth wave in a three-wave movement. Currently, it looks like we're at the bottom of the very first leg down from 2011, and we're looking at the beginnings of an upward retracement of that move. The 1480 level is somewhere around the Fibonacci 50% retracement of the decline since 2011. Gold could retrace more to the upside than that, or it could retrace less. At the current time, though, with us, not too far off the bottom, I'm just saying that we should expect we're going to get at least this much of a rally.
Well, that would tend to agree with, the fundamental analysis we've been covering in Gold Newsletter. And on that topic, in this regard, our audience is made up of diehard gold investors that people sometimes refer to disparagingly as gold bugs.
Yeah.
But unlike the popular characterization of them as being in love of gold or incurably infected with something called gold fever or whatever, I think they're more accurately described as having unswerving confidence in the eventual debasement of fiat currencies. In the lessons of history, I might add, tend to agree with that. But given those lessons from human experience and the unprecedented monetary policies that are currently in action worldwide, including massive inflation of fiat currencies, even negative interest rates, how can your forecast of a long-term decline in gold prices square with fundamentals like that, where we're going to have, for all intents and purposes, an explosion in the amount, or the degree, the quantity of fiat currency?
I'm an expert on technical analysis and the wave principle. I am not an expert when it comes to fundamental analysis. Now, I tend towards the pessimistic side. I do not have great confidence in the judgment of our politicians. But currencies have been regularly debased over the decades, and gold hasn't gone permanently into the stratosphere. So the perceived linkage between worthless currencies and skyrocketing gold simply hasn't been borne out by history.
Well, that brings up the next question I had, that for that gold price of 681 to be realized, it's so far below the average cost of production that it would wipe out, the vast majority of global gold production would be uneconomic. So, as you implied, for that to happen, it would imply that the value of the dollar would have to just soar in some sort of a depression level deflationary environment. So are you or is EWI forecasting such an event?
Yes, we are on record with a forecast that deflation is going to be the problem. We've seen elements that have suggested deflation for years, and it's already a reality in Japan and most recently in Europe. And yet it's not fully obvious to the mainstream. There's a little more understanding and appreciation of it now than there was, say, 10 years ago, but it's still not something that's honestly got most people worried.
Yeah, well, when you look at the fact that there's been literally unprecedented monetary policy and massive quantitative easing still ongoing in Europe, and yet they still have not been able to engender, any significant degree of inflation.
That's right, because all the QE in the world can't change the deflationary mindset. Look at Japan for the last 25 years.
Well, Tom, thank you so much for your time today. This has been a wonderful discussion. I appreciate you giving such depth and insight into the Elliott Wave analysis of gold, and it really helps clarify it a good bit for my readers, I know, and I hope for your subscribers as well.